I often hear people saying that Adobe is at risk of being replaced by AI models, image generators, mobile apps, and so on. But is that really the case? Adobe just reported strong Q2 results. We are talking about double-digit growth in both revenue and EPS, solid cash flow, and an increased full-year guidance. So yet, as you can see from this chart, the stock still dropped around 6% after the earnings came out. So what's really going on? I'm Jaroslav, and in today's video we're gonna break it all down. And just a quick explanation of what Adobe does. They make the tools a lot of people use to create things like Photoshop for photo editing, Premiere Pro for video work, and Illustrator for design. They also have apps for working with PDFs and tools that help businesses with marketing. Basically, if you are creating anything digital, there's a good chance you are using something from Adobe. Alright, so let's move on to revenue, and as we go through it, I'll point out a few key performance indicators along the way. Looking at this chart, you can see that Adobe's revenue has been rising steadily over time, and in the most recent quarter it grew by 11% year over year, from here to here. So no signs of slowdown, no big dips, which is definitely a good sign. Now let's break it down by segments to see where that growth is coming from. And the biggest piece of the pie is digital media, which makes up about 74% of Adobe's total revenue. This is where you'll find Adobe's most popular tools, things like Adobe Reader, Adobe Sign for signing documents, and of course Photoshop, Illustrator, and so on. Basically the whole Creative Cloud suite. And one important thing, most of revenue here comes from subscriptions. But that wasn't always the case. Before 2013, Adobe sold its software as a one-time purchase. What did it mean? You'd buy a version like Photoshop CS6 and it was yours to keep. But if you wanted the next version, you had to pay again. But then Adobe made a big switch to a subscription model, and that changed everything basically. Since then, this part of the business has been growing fast. And as you can see here, in the last quarter alone, digital media revenue was up 11% year over year, from here to here actually, and that tells us people are spending more on Adobe apps, and the trend looks really solid. No signs of slowing down, and the subscription model is a big reason why this segment is so stable. I really like that, it's impressive to be honest. Next up is digital experience, a smaller but still important part of Adobe's business. This segment helps companies better connect with their customers basically. It includes tools for data analytics, marketing, and ad creation. And in the last quarter it grew by about 10% year over year. So again, we're seeing strong and steady performance. I really like that. And finally, we have the smallest segment, publishing and advertising, which makes up only about 1% of total revenue, as you can see here, very small part. Since it's such a small part of the business, we won't spend time on it. So overall, growth looks healthy across all segments, as we could see, but here's the thing, revenue is only part of the story. To really understand how well a business is doing, we also need to look at how revenue growth compares to costs, and that's where margins come in. And before we jump into valuation, let's take a quick look at Adobe's fundamentals. I like using StockUnlock.com here for this. They have a super handy tool called the Insight Score. It rates companies from 1 to 5 on things like profitability, growth, financial health, management, and so on. And a score of 5 means the company is in great shape, and 1 means that there are some red flags. It's a really quick and easy way to get a snapshot of how the business is doing overall. I really like to use that. And right now, as you can see, Adobe scores about 3.8 out of 5, so a bit above average. Let's break it down real quick. Let's start with profitability, and honestly, this part is pretty impressive. If you look at margins, Adobe's numbers are really strong. That's impressive. But to understand if that's normal or exceptional, I compared Adobe to some of its closest competitors. And to be fair, that's not an easy task, I would say, because Adobe is kind of in a league of its own. Most other companies focus on just one area, like Canva for design or DaVinci Resolve for video editing, but Adobe offers a complete all-in-one bundle. You get tools for photo and video editing, graphic and web design, PDFs, cloud storage, marketing, business analytics, and so on, all under one roof. That's very important, yeah, this kind of ecosystem. So I picked what I think are the closest comparable companies, and you can see them on this slide. You can pause it if you want. Now, if you look at this chart, you'll see how Adobe stacks up. Yeah, its gross margin has been incredibly stable over the years, hovering around 90%, which is outstanding, I would say. And compared to these other companies, Adobe is clearly above average. Yeah, and the same goes for operating margins here. Adobe is leading here too, yeah, with around 36%, which is very strong. And when it comes to net margin here, it's a beautiful picture again. Yeah, Adobe continues to outperform. I really like to see that. So overall, in terms of margins, Adobe has a very strong and defensible position compared to its peers. And what's even more impressive, take a look at their free cash flow margins. Yeah, as you can see here, they've consistently stayed above 30%, and now they are sitting above 40%, which is just outstanding, yeah, I would say. And now, as you can see, their free cash flow itself here has absolutely skyrocketed. Yeah, honestly, I'm genuinely amazed by this. It shows how efficiently Adobe turns its revenue into real usable cash, which is something investors really love to see. Alright, now let's move on to the management section. As you can see here, it's true that Adobe stock-based compensation is relatively high, yeah, especially when compared to their free cash flow, where roughly 20% of their total cash is being paid out in stock compensation, which is definitely something to keep an eye on. But here's the key question. Are they offsetting that dilution by buying back shares? And the answer is yes, they actually are. And if you look down here, you can see that their share count has dropped by about 4%. And if we zoom out and look at the long-term trend here, you'll see that Adobe has been consistently reducing its share count over the years. And that's a good sign, yeah, because, it means we as investors aren't being diluted, and the company is effectively using buybacks to balance out the impact of stock-based compensation, which is definitely something good to see. And another thing that really stands out is their return on invested capital, yeah, which is currently sitting at roughly 53%. And simply put, for every single dollar Adobe invests, they are earning about 53 cents in profit. Yeah, that's incredibly high. And if you look at this chart here, you'll notice something else. Yeah, consistency. Yeah, that's very important. Adobe has maintained a high ROIC over time, which is exactly what you'd expect from a company with a strong moat. Yeah, it tells us that they are not just profitable, but they're using their capital very efficiently, which gives them a real edge over the competition. And when it comes to growth, we've already touched on it a bit. And the key takeaway is that Adobe's growth has been stable and consistent over the years. Their subscription model really nailed it. Yeah? It brought in predictable revenue and kept things on track. But what's really impressive here, as you can see, is their net income. Yeah? It jumped 40%. Just look at this chart. Yeah, it's absolutely skyrocketed. So what's driving that growth? Well, a big part of it is the strong growth in subscription revenue, plus the successful rollout of new AI tools like Firefly and Acrobat AI. Yeah, these innovations didn't just boost usage; they also allowed Adobe to raise prices. And at the same time, they've kept costs under control and continued to buy back shares, yeah, which gave an extra lift to their earnings per share. Yeah, so overall, it's a combination of AI innovation and solid business execution that has driven these record profits. Yeah, that's very important. So regarding financial health, as you can see here, if you look at this chart comparing total debt to cash, Adobe actually has more cash on hand than debt. Yeah, so technically they could pay off all their debt tomorrow if they wanted to, so no issues there. Alright, now let's talk about valuation. And for a company like Adobe, I prefer using free cash flow. Why? Well, Adobe is a mature, high-margin software company with a recurring revenue and capital-light business model, which makes free cash flow a really solid metric here. Yeah, basically, free cash flow tells us how much real cash is left after Adobe pays for everything it needs to keep the business running and growing. Yeah. So unlike net income, it cuts out non-cash items like depreciation, so it gives us a clear and more reliable picture of how much cash the company is actually generating. So that's very important. So I'll be using this metric. Now, when we look at Adobe's price compared to its free cash flow, sitting right now at around 19, the stock actually looks quite cheap compared to its competitors. Yeah, and on top of that, it's also trading below its 4-year average, which is around 30, as you can see below the chart. So just based on that, Adobe looks pretty attractive right now, especially when you factor in their strong fundamentals, as we could see. But to really see if this all makes sense, let's run a quick DC evaluation and break it down. Alright, so I run a simple DC evaluation by projecting Adobe's free cash flow over the next 5 years. And by the way, if you've been enjoying all the charts and data I've shared in this video, they are all from StockUnlock.com. It's the tool I personally use every time I analyze a stock. And honestly, it saves me a ton of time. And if you want to check it out, there is a link in the description. You'll get 10% off, and they even offer 30-day money-back guarantee, so there's basically no risk in it. And it's also a great way to support the channel and seriously upgrade your own stock research. Now back to the valuation. I chose to use free cash flow for this analysis, even though the platform offers a few other options, as you can see here. But for a business like Adobe, this one just made the most sense for me. So for the next 5 years, I went with a 10% annual growth rate for Adobe's free cash flow. And you might be wondering why this growth. Yeah, well, I looked at a few projections and I checked what analysts are saying, and most of them expect growth somewhere between 10% and 15% per year over that period. But just to be on the safe side, I decided to stick with the lower end, 10%, actually, to give myself a bit of a margin of safety. And this kind of growth looks totally realistic and achievable to me, and you can see exactly what I mean in this chart below. That's projected free cash flow. And when it comes to the valuation multiple, I went with 25, which is actually below Adobe's historical average of around 35, as you can see here. Now, in my opinion, Adobe definitely deserves a premium. Yeah, we are talking about incredibly high margins, yeah, and a massive return on invested capital, numbers that most companies can only dream of. Yeah, so personally, I wouldn't be surprised if this multiple eventually climbs back up to 35 over time. And with these assumptions, we are looking at roughly a 19% return from today's price over the next 5 years, and that's really appealing. So, my final thoughts, well, with such strong fundamentals, we are talking about high margins, a recurring subscription model, and fantastic return on invested capital. The stock honestly looks like a steal to me. Yeah, this price, I find it very attractive, and yep, I'm actually buying. Yeah, and of course, this isn't financial advice. Yeah, always make sure to do your own research. And now one thing I really wanted to highlight is Adobe's moat, especially when it comes to switching costs. Yeah. They offer a huge range of apps, yeah, as we could see, and once you've learned how to use them, you really don't want to start over with something else, yeah. And the best part, everything's under one roof, yeah. It's an incredibly strong ecosystem, and that kind of integration is hard to compete with, yeah. Oh, and one last thing about AI. Do I think Adobe will get replaced by AI? Honestly, no. I believe it's not always the company that builds the most advanced AI that wins. Yeah, it's the one that knows how to actually use it smartly. Yeah, and that's where Adobe really shines. And that's what Adobe did. Yeah, they didn't build the coolest AI, but they added it into the tools people already know and love. Yeah, and just like that, it's helping them make billions. Alright, that was my take on Adobe. If you found this video helpful, please make sure to hit the like button, subscribe, and as always, thanks so much for watching, and I'll see you in the next one. Bye.